All right, now before we talk about what Jerome Powell just said and the impact that lower rates are going to have on the entire economy, let's talk about the housing market. In terms of what we're currently seeing, it's no surprise that housing prices are beginning to slump as more inventory gets listed on the market. And for the first time in years, housing is beginning to lag inflation. In fact, it's said that American housing wealth has actually declined in inflation-adjusted terms over the past year. What's even more apparent is that we're quickly noticing a very big divide in the housing market between those who locked in historically low mortgages and those who bought in the last 2 years. Like, as you can see, the average existing interest rate on California mortgages is currently at 3.8% versus new mortgages coming in at 6.6%. This means you have one segment of the market locked into low interest rates and refusing to move, while the other is paying double for an identical house. Given that, when a home is listed, buyers now have more room to negotiate. They can afford to be pickier because there is more to choose from. And when you look at the overall buyer pool today, there are fewer people willing to pay today's prices that haven't already purchased something. Of course, in terms of whether or not lower interest rates are going to positively affect the housing market, the answer is it depends. Unfortunately, like I mentioned earlier, the Federal Reserve does not have a direct impact on mortgage rates. Instead, those are influenced by the 10-year Treasury yield, which are dictated by market supply and demand.